major layoffs.
Silicon Valley is on a firing spree.
For 11,000 planned job cuts at Meta.
About yet another tech company conducting these mass layoffs.
The tech industry could expect more layoffs for another 3 to 6 months.
By now, you've probably heard about the tech purge. Stripe cut 1,100 jobs, Coinbase cut 1,100 jobs, Shopify cut 1,000 jobs, Snapchat cut 1,000 jobs, Robinhood laid off a third of their staff, Tesla laid off a tenth of their salaried staff, and Meta laid off a whopping 11,000 employees. And those are just the companies that have already resorted to layoffs. While the remaining big tech companies haven't started laying off people yet, they have pulled back on hiring substantially. Apple, Google, Microsoft, Uber, Lyft, Nvidia, Intel, and many more all have hiring freezes in place. Now, you can't feel too bad for these employees because it's not the same as blue-collar workers being laid off. Most of these guys were earning high 200s if not more and were on track to becoming deca millionaires. So it's not like they'll be struggling to get by. What may be difficult, however, is scoring another job with the same compensation. With all of Silicon Valley pulling back, many of these guys will be forced to find jobs at background companies like AT&T or Texas Instruments. While these companies will still pay generously in relation to what the average American earns, their total compensation will be nowhere near what Silicon Valley offered. For example, the highest paid software engineers at AT&T earn $145,000 per year, which is not a bad amount. But the highest paid software engineers at Facebook earn $1.82 million per year. Even the entry level at Facebook is $23,000 higher than the best level at AT&T. Also, these background companies will probably be hesitant when it comes to extending job offers to these laid-off FAANG employees. Not because they're not qualified, but because they definitely won't be loyal. Everyone knows that these guys will switch back to Silicon Valley as soon as it becomes viable. So it doesn't make a whole lot of sense to hire someone that you know will probably be gone in 2 years. And the main reason for this is simply how absurd Silicon Valley compensations have gotten. So how did these compensations get so high? And will we see FAANG ever return to paying these salaries? At first glance, it's easy to write off FAANG's massive salaries as a result of their profitability. These companies often have profit margins of 30 or 40%, so they're able to pay rather high salaries and still make a bunch of money. And while this does play a role in FAANG's compensation, it's by far the smallest factor. The main factor allowing for such compensation is actually the exponential growth of these companies. If you take a closer look at FAANG compensation, you'll see that the vast majority comes from stock-based compensation, and that their base salaries aren't actually all that crazy. Product directors get paid $1.34 million per year, but only $325,000 of that is actually base salary. Product directors at FAANG are equivalent to vice presidents at non-FAANG companies like Exxon. And you wouldn't be that surprised to hear that an Exxon VP is making $300,000 to $500,000 per year. So if we're just looking at base salaries, FAANG companies aren't actually all that different from non-FAANG companies. The real difference is that on top of this, you get paid $898,000 in stock at Facebook. Now, there's a few good reasons that FAANG does this. First of all, if your employees own stock, they'll be far more motivated to help the company make more money. And secondly, stock compensation generally comes with vesting periods of 4 years, meaning that employees have to stick around for at least 4 years to redeem all of their stock. So this kind of locks them in for a bit. Insiders like to call this the golden handcuffs. But the main reason that so much of the compensation comes from stock is because that's the only way these companies can afford to pay out such salaries. While these companies do make a bunch of money, even they wouldn't be able to pay these salaries in cash. But wait a minute, isn't stock compensation the same thing? Don't companies have to pay for the stock that they award their employees? Well, yes they do, but not in the way that you might think. Facebook doesn't go onto the stock market and buy $900,000 worth of stock so that they can pay a director. Instead, they simply dilute existing shareholders and print new stock. Facebook, for example, had 87,000 employees before the layoffs. If we assume that the average Facebook employee gets $100,000 worth of stock every year, that works out to a total stock compensation of $8.7 billion per year. If Facebook paid this in cash, that would wipe out a third of their net income. But when they were worth $1 trillion, this compensation was equivalent to less than 1% shareholder dilution. I think you can see why the latter is far preferred. The only caveat is that these companies have to continue growing exponentially. If these companies start to stagnate, or worse, start to sell off, shareholders will no longer be okay with the dilution. This is why stagnant companies like Exxon and AT&T can't compete with FAANG in terms of total compensation. While they're able to come close in terms of cash compensation, they simply can't afford the same dilution. And speaking of dilution, with how the stocks of high-flying companies have been performing, it's not clear if Silicon Valley can afford such dilution moving forward either. And it's no secret that the stock market has been getting destroyed, and most of this destruction has centered around Silicon Valley. Affirm is down at 90%, Robinhood is down at 80%, Lyft is down at 83%, Netflix is down 58%, and even Facebook is down 75%. As these companies sell off, stock compensation-related dilution becomes more and more expensive, especially for new hires. Remember the $8.7 billion that we calculated for Facebook? At a $1 trillion valuation, that's less than 1% dilution. But at their current $300 billion valuation, that's closer to 3% dilution. And where this becomes really dangerous is if Facebook doesn't grow for the next 10 years. From an outside perspective, this wouldn't be that bad. After all, $300 billion is still a ginormous valuation, and Facebook would probably still be making plenty of money. But from a shareholder perspective, this would be a disaster. Here's the thing, 3% dilution for 10 years works out to 30% total dilution. This means that if you had a $100,000 stake in Facebook, it would be worth $70,000 by the end of 10 years, even though the company itself stayed stable. Factor in inflation, and your initial $100,000 stake is now worth closer to just $50,000. I think you can see why investors aren't exactly thrilled to pick up these companies, even though they're down so much. And honestly, looking forward, it doesn't look too good for any of the Silicon Valley giants. Apple iPhone sales peaked years ago. This is why Apple stopped reporting how many iPhones they sold and started increasing prices aggressively. They were able to continue growing profits thanks to these price increases along with services revenue. But it looks like the upside from these are starting to run out, not because Apple is doing anything wrong, but simply because they've reached market saturation. And it looks like it's the same case with all of their tech peers as well. Out of the 4.72 billion people who have access to the internet, 4.3 billion already use Google. Similarly, Instagram is about to reach 2.58 billion monthly active users, and WhatsApp is at 2.2 billion users. How many more people could realistically use Google, YouTube, Netflix, iCloud, and Uber? The answer is not that many. All these companies are essentially mega monopolies that have already captured the entire market. And with advertisers pulling back due to the recession, these companies will make less money even with the stable user count. And there's no question that this will result in these companies rethinking just how much they're paying their employees. Alright, so here's what we've established. The only reason that tech companies are able to pay so much is because most of the compensation is in the form of stock, which is paid for by stock dilution. This, however, only works when the company's stocks are booming. With these companies reaching market saturation along with the economic uncertainty, it's not clear how much longer these companies can pay these insane salaries. And that brings us to the crossroads that we're at today. These companies really only have two options, with the first being pivoting to a new industry with plenty of growth left. The company that's most iconic for trying to do this is of course Facebook. They changed their company's name to Meta, and they're betting it all on the metaverse. They're literally looking to spend $100 billion on this. And while they received a lot of criticism for this, there's no question that if they are able to figure it out in the way that they've envisioned it, as opposed to how it is right now, it would truly be huge. This would likely be enough for Meta to grow to a multi-trillion-dollar market cap, if not over $10 trillion, allowing them to make their stock compensation even more ludicrous. Another company who's betting it all is Netflix. Netflix is turning around and spending all of their earnings into in-house productions. They're hoping that this will make them more independent of production studios. And given that they spent $270 million on the most recent season of Stranger Things, they're clearly taking this pretty seriously. Investors, on the other hand, are scared of these massive pivots, and that's why these stocks are down the most. Conversely, some other tech giants are choosing to play it safe and are slowly becoming dividend stocks. Likely the two best examples of this are Apple and Microsoft. Unlike Google, Facebook, Netflix, and Amazon, Apple and Microsoft already pay dividends, and it looks like they're simply going to lean more into this. These companies were already on the lower end of FAANG compensation. At Apple, for example, even the top-level software engineers were only getting paid $677,000 per year, which is almost 3 times less than the top engineers at Facebook. As these companies choose different paths moving forward, it appears that this discrepancy will only grow larger. In the end, with all these tech layoffs, it appears that the ball is finally shifting from the employee side to the employer side. Thanks to the seemingly unlimited VC funding and hypergrowth associated with these companies, employees have been able to negotiate salaries as high as 7 figures. But with the economic downturn and a bunch of newly laid off tech workers looking for work, it doesn't seem like these numbers will fly anymore, at least not for some time. In the meantime, these guys will probably have to take a substantial pay cut and join a background company or maybe even start their own company. On the bright side though, I doubt that the recession is going to wipe out any of these big tech names. Eventually, they will get to the other side and start hiring again. But when they do it, the compensations will probably look a lot different. Companies that are choosing stability like Apple and Microsoft will likely be far less generous when it comes to handing out stock. If they're embracing dividends, they can't also embrace growth and dilution. On the other hand, companies like Facebook and startups like Coinbase will likely hand out more stock compensation than ever. But that of course comes along with a bunch of additional risk. You're essentially betting that the metaverse or whatever product the company is pivoting to will actually pan out. So it appears that the days of low-risk, high compensation are quickly coming to an end. But that's just what I think. Do you think the metaverse will pan out? Comment that down below. Also, drop a like if you wish FAANG salaries became the norm. And of course, consider checking out our Discord community to suggest future video ideas and consider subscribing to see more questions ultimately answered. But until then, I'm Hari, and I'll see you guys on the next one.